Hi, this is Christopher Lewis from the dailyforex.com trading desk, and today I will be giving you an analysis of the cable or the pound dollar pair in the first of a series of videos that will begin to supplement our technical analysis articles. The February 7th Forex session is what I'm looking for, as this is being filmed at the close of the February 6th. As you can see in the cable dollar pair, we have formed a hammer. Very positive and bullish sign, and many traders will look at this and want to get involved right away. I have some support and resistance levels drawn, and 155 is basically because it is a large round number and the markets do tend to react to them. Although you can see it has sliced through it a bit here and there, there is a bit of a reaction. 153 is obvious support, and if you zoom out on this chart you can definitely see that, but these three times that we've hit here have been pretty obvious. And of course the 158 has kept prices down until recently. Looking at this chart, I also have a 200-day moving average, and that'll come into play as well. But there are some other areas that we want to be aware of. The first thing that I would say about this chart is it's been an incredible bull run for the pound. As you can see, just a scant 3 weeks or so ago, we were about 550 pips below where we are now. And at one point, we were up about 650 pips. That's a pretty significant move in less than a month. Not only that, you can see that the move was straight up. Every pullback has been very shallow, so a lot of traders have actually missed this trade, would be my suspicion, because they're going to want to see some type of pullback in which to get involved. It was counter trend. You saw this massive move down, so when you saw the pair start to rise here, it was very difficult, and I myself would have had trouble going long, especially once we broke above the shooting star. Although that's a bullish signal, you've got a lot of noise here. So you can only use the law of probabilities, and that's what this video is about. Looking at the pound dollar, I see some significant things going on at one point or another in very close proximity. The candle from the Monday session is a hammer, and of course that's very supportive, and that isn't a hammer, it's a doji, but it does mean essentially the same thing in this context. We tried to break down and we found support. The problem with this is a lot of traders will use this as a signal to go long if you break the top of the range, and rightfully so under most circumstances. But you can see that we are approaching a resistance area at just 159. So at this point in time, the typical trade would be to go long and aim for 159 and then put your stop loss in at the bottom of this hammer. Well, the biggest problem you're going to have with this is you're going to be risking about 2 for the 1 that you're trying to gain, roughly. I haven't measured it, but you can see that we would be aiming to about here, and the candle is about twice as long. Not very good risk-reward ratio. On top of that, we have just above that the 160 area, which while it was sliced through previously, 160 will cause some type of reaction, even if it is just temporary, because of the fact that it's 160. It's a large round number. Traders like these things. So looking at this and looking at the parabolic attitude of this move, some traders would want to short it. Now, you can also look at this and say that there are some points where you could do that. You can see that the day's session dropped to about 157 and bounced, and you can also see that at one point in time this 157 to 158 area was resistance, the entire area. We just couldn't close above 157 basically. So that actually has this as resistance, and this should be support. What was one support becomes resistance, and vice versa. Think of it as going from one floor to the next on a skyscraper. You're now standing on the ceiling of the floor below. Now that we've popped up through this and we've pulled back and we've got supportive action, that does look good. However, below this we have another supportive area, which I will call 156. So I actually have two areas that could be supportive. I know that there's going to be some trouble coming up possibly, but it's obvious that the pair wants to rise. Barring some type of meltdown in Europe, we should see a continuation of this, mainly because the numbers in England are getting better, and the Federal Reserve has already guaranteed ultra low interest rates until the end of 2014. So while the UK is heavily exposed to the euro and to the European countries, as long as that situation doesn't implode, this should be a currency that should rise for a while at least. It's the pound was oversold is essentially what the market I think believes. So now we have a setup where we've got all of these different levels, and looking at this chart, I know that I don't have enough room to go long here, so I'm essentially just waiting for some type of pullback. I have the 200-day moving average just drawn out of interest. It's an area that a lot of traders look at, and we did close slightly above it. This is one of those moves that if it does break higher, you just simply have to let it go. It has become parabolic, lacking any sense, lacking any order, and these are the type of moves that will get traders hurt. You know, we may wake up in the morning and find this at 161, and that's fine. There are cleaner charts to trade. But if we get a pullback, we want to know where to look for trades. And currently, right now, have 157 and 156 as possible buying areas. And what I'll want to see is some type of like four-hour hammer, a daily hammer, something to that effect, or a bullish engulfing candle. And the reason for this is it gives me room before we run into serious trouble. If this pulls back, all of these resistance areas that had become support won't fight quite as much. We've already violated it. So if we pull back to say 156 and we go long, we have a chance to go up to 159. That's a 300 pip zone. That's a little bit more room to work with, and that's what I'm looking for in the pound right now. Conversely, if we manage to close below this hammer, which would be two hammers getting broken, that's a significant sell-off in support, and it is going with the longer-term trend. I would be willing to sell there. But we've got a couple areas we have to work through before we get to that point. So I did this video just looking at it as it looks messy, but there really are some levels to be involved with here. The question is are you going to get the room to justify risking your trading capital? You may or may not, and if you don't, that's fine. There's always another setup around the corner. However, now that we've broken down some levels, we at least know where we may want to get involved. And again, to recap, I would be looking for support at 157 and 156. Both of those areas give me a little bit of room to perhaps make some profit to justify risking my trading capital. And also, if we break this second hammer, then, well, we have to assume that sentiment is changing rapidly. So we are in an interesting inflection point in the pound, but we have a lot of levels in a fairly constricted space, so we need to be very careful about how we choose to go.